Fed Reserve Chairman Ben Bernanke downplaying fears that an increase in oil prices may affect the recovery in the United States and globally. In a testimony before the Senate Banking Committee, Bernanke said that unless the surge in prices is sustained, it will not hurt the economy, and that inflation, he says, is likely to remain modest.
FOMC participants see inflation remaining low. Most project that overall inflation will be about 1.25% to 1.75% this year, and in the range of 1% to 2% next year and in 2013.
Joining us now to discuss is our guest host for the next hour, Steve Forbes, chairman at Forbes Media. Great to have you with us again, Steve. Thank you so much. We really appreciate it. So the question is, we alluded to this fantastic ISM number we had yesterday, but beneath that it showed that 82% of companies are starting to see increased costs. And then you hear Fed Chairman Ben Bernanke saying, no, forget about it. Inflation is not a big deal. So who do you believe? Do you believe your eyes, or do you believe the Fed Chairman?
I think Ben Bernanke really needs a message from Earth that we have a real problem with the weak dollar that has been very destabilizing, encouraging commodity speculation, currency speculation. What's happening in oil, Nicole, is not just the Middle East, but also the weak dollar. So if you had a stable dollar, you'd probably see $50 a barrel, $60 a barrel oil. It's had devastating impact on food prices in the developing countries. So this just doesn't impact the U.S., this impacts the whole world.
And we're not talking enough about the dollar. The dollar is at a 4-month low right now, slipping against major indexes across the world. If this dollar weakness continues, if we see another 5 to 10% off, what does that mean? What are the implications there? I mean, are we starting to feel a little bit like the 70s around the edges with devaluing the dollar and backing that up with deficits?
Cheapening your money is never the way to wealth. If it was, Zimbabwe and Argentina would own the world today.
That's right.
And that's why U.S. Stock market, even though it's been up until recently, 12 years, going nowhere. The standard of living in the U.S. has been stagnant for several years because of the weak dollar. So there's no quick way to wealth, and cheapening the dollar, you never get a sustained, strong recovery when you cheapen your money like we're doing to the dollar.
And we're also seeing attacks on the consumer with this inflation that you're talking about.
It does two things. One is a weak dollar is a form of protectionism, trying to readjust the trade balance instead of doing it the honest way. The other thing it does is a tax, and the nice thing about that tax from the political point of view is you don't have to get it through Congress.
No, it's not coming out of Washington. You're seeing it on Earth, like you said, Earth to Bernanke. But we're also seeing attacks on the consumer in terms of oil prices as well. Gas prices up 25%.
You're seeing it in food prices, and those manufacturers, as you alluded to, most of them are seeing prices going up. So this may not be a 15%, 13% inflation that we had in the 1970s, but it's enough to make this recovery suspect, and that's not what we need right now.
And you said recently that this is a car moving at 35 miles an hour. Suppose that's better as a country than running on empty.
But
still not good.
We're capable of going 70, and at this point in a recovery, we should be good doing 65, 70 instead of puttering at 35 or 40.
Ross, do you go that fast on the highway? Here's a question for you.
Yeah, it's one of the countries in Europe, I think, is just thinking of doing what Carter did, reducing the speed limits, down to 50 miles an hour. I just want to pick up on the comment, Steve, that Mervyn King said yesterday. Standards of living could take years to recover from a crisis, and as this cost, and as the cost of living goes up, of course, we're going to only feel worse about that. How is that going to impact us generally here? Because we're all going to feel, the majority of people in the country are going to feel worse off. And I just want to, we try to sort of buy them off with cheap credit in the last 20 years. The political trick was give them cheap credit so they don't realise that actually they're getting less real incomes. And now that we can't do that anymore.
No, and when you cheapen credit, you get, as you know, misallocation of capital so that real growth industries are thwarted instead of being encouraged. And in terms of the UK, for example, the austerity, yes, government spending has to be cut back, as we're doing here in the U.S. on the state level. Federal level, we're just beginning on it. But raising taxes substantially, at least at the margin, 50% tax rate that you now have in Britain, that's going to hurt recovery. So I think we have to go back to the early 1980s, back to the future, and that is instead of more austerity, instead of resigning ourselves to years of wearing more and more threadbare clothes, we should do what Reagan did, and that is stabilize the currency, reduce tax rates, go for another round of deregulation, inflation, and by golly, these economies would come back, both in Western Europe and Asia's doing okay, but it would do better. And certainly here in the United States, we need a higher speed than we're achieving today.
Golly, if it were just that easy.
Well, the principles are easy. It's just a lot of politicians have a hard time seeing it. Reagan was accused of being a simpleton. I mean, just stabilize the dollar, reduce tax rates, the economy would get back on track. Well, guess what happened? That's just what it did. We had a 25-year ride from it.
And the concern is stagflation. We're already getting a lot of questions in about tax cuts, flat tax cuts questions, as you can imagine. We'll get to those throughout the rest of the hour. Steve Forbes, chairman at Forbes Media, stays with us for the entire hour. We're lucky to have him with us. Here are some big stories we're following for you. This early morning hour, the Senate will vote at 11 o'clock in the morning on a bill that the House passed on Tuesday to extend government funding for 2 weeks to avoid a possible federal shutdown this weekend. This gives lawmakers more time to resolve the battle over spending cuts for the current fiscal year. House Republicans are pushing for $61 billion in cuts. Democrats say that would endanger the economic recovery and throw thousands of people out of work. Also, a big headline this morning, the lawyer for Raj Rajaratnam is dismissing charges by the SEC that a former Goldman Sachs board member gave the hedge fund manager inside information. Rajat Gupta is accused of leaking details about Warren Buffett's plans to invest $5 billion in Goldman at the height of the financial crisis. Gupta also allegedly tipped off Rajaratnam about earnings at Goldman and Procter & Gamble. We should note that Gupta stepped down from Goldman's board last May. He resigned from P&G's board Tuesday. As of this morning, though, we just checked, and he is still on the board of AMR, the parent company of American Airlines. Steve, what do you make of this story?
I think it's the whole thing of the SEC trying to make up for lost ground in terms of the crisis 2 or 3 years ago. And we don't know what the real details are. But one of the things that I hope will eventually come out of all of this is what is insider trading. We know this sounds like an open and shut case. You gave information that wasn't out in the public, but there's a lot of murky ground out there, and the courts have got to resolve this. They've never defined what is insider trading, so you know what you should do and not do, instead of the prosecutors coming and saying, you search for information that wasn't public, like a hedge fund. That's what they're paid to do, and therefore we're coming after you. No, that is not insider trading. That's trying to find out what's going on.
That's a competitive advantage?
Yeah.
Some sort. So how would you define that?
I think you make it very clear. If you're a member of a board, like what apparently happened in this case, and you leak information that has not been formally released to the public or to a group of security analysts or the like, that's a violation of the law. But this other thing where if you're a hedge fund or an investor and you're searching out, talking to experts, trying to find out what's happening, you're counting, you're looking at who's parking at a car at a certain company, so that means there's a merger maybe going on, discussions going on, that kind of thing is fair game.
So, I mean, it's on the front page of the Journal this morning. What kind of ramifications do you think this is going to have for Goldman and Berkshire and the like?
Well, what it is, it puts a huge cloud over it, and for Goldman knows, even though it's a mighty company, it survives at the sufferance of the U.S. government. And not to be black helicopters, but that crazy economic report they came out with the other day, which looked like it was written by the White House press room, a lot of people have speculated, why in the world did Goldman's economists do this? Well, I think some of us suspect that they know who their real boss is.
The vampire squid story continues. Steve Forbes, great to have you with us.